Welcome to this lesson on the Italian tax system. Our country's tax system is a fundamental pillar of the national economy, essential for funding public services and redistributing wealth. Understanding its structure is crucial for every citizen and student. This system is firmly anchored and regulated by constitutional principles, which guarantee its legitimacy and fairness. The Italian constitution, with its foresight, has laid the foundations for fair and proportionate taxation. In particular, the key reference is Article 53 of the Italian Constitution. This article establishes the ethical and practical foundations on which the country's entire tax system is based. Without it, the system would lack clear direction and a foundation of justice. Article 53 establishes two fundamental principles that guide the application of taxes. These principles are not merely theoretical dictates but inform every tax law and collection practice. They aim to balance the needs of the state with the rights of taxpayers. The first of these is the ability to pay principal. This concept is the cornerstone of a fair and proportionate tax system. It ensures that the tax burden is distributed according to each person's actual economic possibilities. The definition of this principle is clear. Everyone is required to contribute to public expenditures. This implies a collective responsibility for the common good. No one is exempt from contributing, but the amount of that contribution varies. The basis of one's ability to contribute is therefore determined by one's wealth. This means that one does not contribute equally, but rather in proportion to one's economic resources. It is a concept of social justice applied to taxation. The second fundamental principle is that of progressivity. This principle complements the ability to contribute and reinforces the objective of equity. It ensures that those who have more contribute a greater percentage. The specific definition of this principle is that the tax rate increases as income increases. It is therefore not a linear taxation system, but a bracketed system. The highest rates apply only to the highest incomes. The primary objective of progressivity is to ensure greater social equity. By reducing inequalities through taxation, we contribute to creating a more just and cohesive society. It is a powerful tool for the redistribution of wealth. Let's now examine the main taxes that make up the Italian tax system. These taxes represent the lifeblood that supports the state and its services. Knowing them is essential to understanding how the public machine works. IRPEF is undoubtedly one of the most well known and discussed taxes. It is levied on personal income, that is, on all earnings earned by an individual in a tax year. It is a direct and personal tax. The income categories included in IRPEF are numerous and varied. These include income from employment, self employment, property, capital, and other income. The taxable base is therefore broad and inclusive. The personal income tax (IRPEF) structure is organized into brackets, a mechanism that allows for the application of the principle of progressivity. This system is designed to make taxation more equitable based on different income levels. Each bracket has its own specific rate. Tax brackets are income ranges predefined by law. Each bracket represents a range of income to which a specific tax rate applies. The thresholds for these brackets are periodically revised to adapt to economic trends. Each income bracket corresponds to a specific rate, which increases progressively. This means that lower incomes are taxed at lower rates than higher incomes. This correspondence is the heart of progressivity. The nature of the rate, as already mentioned, is progressive. This means that the tax burden is not a fixed percentage applied to the entire income, but varies as income increases. This mechanism aims to protect the lowest incomes. The application mechanism is crucial to understanding personal income tax. The higher rate applies only to the portion of income falling within the higher tax bracket, not to the entire income. Each portion of income is taxed at the rate for its respective tax bracket, thus ensuring a graduated taxation. ERS, corporate income tax, is a tax levied on the profits of legal entities. This tax is crucial for financing the state through contributions from economic activities organized as corporations. It differs from ERPEF, personal income tax, in terms of the type of taxable entity. Its description clarifies that it is a tax levied on the income of joint stock companies. This includes entities such as joint stock companies, SPAs, limited liability companies, LLCs, and limited liability companies, SAPs, which are the most common legal forms for large and medium sized businesses. Its purpose is to tax the income generating capacity of these entities. The application of IRS also extends to commercial entities, both public and private, and other similar entities. This extension ensures that a wide range of income generating organizations contribute to the tax system. It is a tax that aims to cover all forms of structured business. The general functioning of IRS is, in many respects, similar to that of IRPEF, in terms of determining the taxable base and taxation periods. Both taxes aim to impact the earning capacity, albeit of different individuals. However, there is a key difference between IRS and IRPEF. IRS applies a flat rate, unlike the progressive tax brackets of IRPEF. Currently, the rate is set as a single percentage applied to the entire taxable income. The IRS taxable base is calculated on taxable income. This is obtained by subtracting deductible costs and losses from total revenues according to current tax regulations. It is a complex calculation that requires accounting precision. Let's now move on to VAT, value added tax, which is profoundly different in nature from the direct taxes previously examined. It is an indirect tax which manifests itself differently in everyday economic life. The tax is indeed indirect in nature. This means it doesn't directly affect income or wealth, but rather consumption and transactions. It's a tax that's hidden in the final price of goods and services. The tax's purpose is specific. It applies to the added value of goods and services at every stage of production and distribution. Every time a product or service acquires value along the supply chain, VAT is levied. The application phases are multiple, extending to every stage of production and distribution. From producer to wholesaler, from retailer to final consumer, VAT is applied at every step that generates value. The VAT mechanism is based on the principle of recoupment. This system allows the burden of the tax to be passed along the production chain all the way to the final consumer. It is a system that compensates itself at each stage. The concept of recoupment is twofold. For input VAT, the seller has the option of recovering the VAT paid on their purchases of goods and services. This mechanism avoids cascading taxation and the doubling of the tax. Conversely, for output VAT, the seller charges VAT to the end customer for the goods or services sold. This VAT is then paid to the Treasury after deducting the input VAT. This is how the state collects its share. The final payer of VAT is always the end consumer. Although it is collected at every stage, the economic burden of the tax falls entirely on the final purchaser of the good or service. It is the consumer who bears the cost. VAT collection methods are unique. It is collected in fractions along the production chain. Each operator pays the tax authorities the difference between the VAT collected from their customers and that paid to their suppliers. This system ensures a constant flow of revenue for the state and greater traceability. I hope this analysis has provided you with a clear and in-depth overview of the Italian tax system, its founding principles, and its main taxes. Understanding these mechanisms is essential for an informed and active citizenry